I've been publishing stocks for several years now. And if you know me, you know that I wear a Trifecta t-shirt when I think a stock is an incredible buy. And I did that for this stock. And it's up 600% since I called it a buy in November of 2022. I'm going to rehash that stock for you today. I'm going to show you the videos that I did back in the day where I identified the stock. I thought it was interesting. And we're going to look at it now and see what happened since then. There's a huge opportunity in the stock market to find stocks that no one else is looking at. Why? Because like I said earlier, half the money, if not more than half the money in the stock market is currently indexed, meaning no one's doing fundamental analysis for the stocks that are being selected within that index. That leaves an opportunity for you, for me, to find stocks who are generating high free cash flow, growing revenue, growing EBITDA, low debt, well priced. And if you wait for the stock to come to you, you can hit a home run. So right now I'm going to tell you the secret to finding a great stock. Are you ready? The secret is this: they're not always available. I know that sounds shocking, but you have to wait for the stock to come to you. Too many people are sold by Jim Cramer saying there's a bull market somewhere, I'm going to find it for you. The reality is you're going to sit there for a long, long time waiting for a couple stocks, and then once, maybe every 5, every 10 years, an opportunity is going to show up that is so clear cut, you're going to dive in and you're going to make 600%. But you got to be patient. You got to know what you're doing. I'm going to show you how to do it right now. All right, so here we are. You ready? The stock that I'm going to review is Meta. Meta stock is up 600% since I reviewed it in November of 2022 and in February of 2022. As of this minute, the video, roughly February of 25, the stock is at $714 a share. I looked at it in February of 22. It was $200 a share. I said it was it was interesting. And then at November, just another, 10 months later, November of 22, it fell in half from there to $113, where I did the famous Trifecta t-shirt. I call it a buy. I really love the stock at that point, and it's moved from $313 a share up now to $714 a share. So I hope you dove in. I hope you like the stock. Let's dive back through, take a look at their stock reviews. Then I want to go through the long-term history of Meta, show you the cash flow potential, reevaluate the stock today, and figure out, is it a buy or not? All right, so here I am looking at the earlier view. This is February of 2022. I'm going through the forecast of the stock. I'm taking a look and saying what I think about what I think about the company.
15 times, 10 times to me seems too small. 15 seems okay.
I'll fast forward. You don't need to watch the whole video. You can watch for yourself later. But you can see here's $200. I'm calling it 17% IRR. I give it a decent review. I liked it at the time, but I wasn't ecstatic about it. Fast forward, you get me in November 2022. I brought down the forecast because the market itself was really, really rough. Still 17%, but I thought the buying point at $113 a share was absolutely a steal, and that's why I'm wearing the Trifecta t-shirt. Remember, Trifecta, that is growing earnings, market multiple expansion opportunity, and buying back shares. And Meta fit all three of those right away, and I called it as a Trifecta, and I hope you picked it up at that point too. All right, so now familiar with the format of the one-pager. This is a cash flow club that we run. I have several analysts that work for me. We post one-pagers. They're 10-year reviews of stocks that we think are very interesting from a cash flow perspective. If you're interested in working for me, feel free to email me. Descriptions below, but I've helped analysts in the past get jobs in large money management firms. I teach them how to, as a CFO, as a CFA, how do you evaluate cash flow? If you're passionate about valuing stocks like I am, reach out to me. Happy to help you grow your career. So here we go. David's posting in here about Meta. That Meta's long-term debt, $22 billion, cash position, $77 billion. Absolutely love that. Kind of giving a rundown. Messenger, Instagram, and WhatsApp is pretty much what they own. Launched in 2004. Let's see. Revenue growth grew by 22% from $134 billion to $164 billion. Absolutely lights out, crazy. Let's take a look at some charts, visualize this data. So here's a 10-year stock return chart. I think this is really interesting because it definitely shows how you have to sit back and wait for a stock to come to you. Get the price that you want. Don't pay what the market is paying. Sit back and really wait for it. If you were patient on this stock, it absolutely cratered here in 2022, and it became a monster steal as the market turned negative. Zuckerberg was not in his smoking meat, judo, gold chain wearing Macho Man series. He was kind of, I don't know how to put it politely, but he was just not that image. No, people lost confidence in him. He was spending a ton of money in his various avatar-related Ponzi schemes or just boondoggles of projects, and he finally shifted over into AI. That's really a boom, and I think his vision of the company has now finally changed. He kind of got his feet back under him, got his arms around the company, and really started steering it, and you're seeing the result. But that opportunity only presents itself when you wait for the stock. That's not something you just dollar cost average into. I really like this chart. This is the 10-year last 12 months of revenue. So it's an annual revenue number shown on a quarterly basis, and it shows it growing from 2003, 17, $18 billion, up to $165 billion in the last 12 months. Absolute monster growth. Growth pretty much every year, with the exception of 2022 when it started to wane, and that's when the stock absolutely cratered. Lesson for the growth stock investors that are in NVIDIA and others: if those things stumble any whatsoever, it will absolutely crater. Here's revenue expressed as a growth figure. You can see here revenue was growing strongly. This is year-over-year revenue growth. We're talking 40+%, 30%, beautiful. And then in 2022, it actually goes flat to negative. Now it's back up at 20%. They're expecting it to grow 20% next year. But that switch from 20% growth to negative absolutely cratered the stock and created an amazing, amazing buying opportunity. I'm going to zip through some of these. I got lots of charts here. If you're in the cash flow club, you can go through any of these stocks and that we review and get this kind of data. It's really amazing. 10-year adjusted free cash flow. So that has also continued to grow. A lot of these meme stocks, you're watching them, revenue's going north, but free cash flow's not. Stocks like Google, Facebook, and Amazon continue to print cash. I really like that, and I really like the Facebook stock. Look at this thing continue to grow. It had a rough patch, yeah, but it reverted back quickly as leadership got their arms around the business, and now they produced $37 billion of adjusted free cash flow last 12 months. You can also see they're buying back a monster amount of shares. Remember, that was part of the trifecta where you're buying back shares. Not necessarily paying a dividend at the time, but you're just buying back shares. So this is a very important chart right here. Let me pull this up for you. Right here, you got LTM EBITDA adjusted. This is last 12 months of EBITDA expressed on a quarterly basis. You got the line. The line is the enterprise value to EBITDA ratio, and I'll explain this later on. But it's a relative value metric. It shows your total enterprise value divided by your EBITDA. And growth stocks typically don't have a low multiple, right? They have a 30, 40 times X multiple range, sometimes even higher. What's interesting about this wonderful stock is here's a stock with low debt, growing revenue, generating free cash flow, phenomenal business market position, and you could have purchased this stock, this growth stock, for roughly 8 times EBITDA in 2022, a price per cash flow unheard of. In fact, never traded that cheaply in its history of operations, I'm willing to bet, at that level. That's an incredible price. You saw it here in the program. I had the Trifecta shirt. I was calling it out. And what did it do? It reverted from 7x to 21x. That is a market multiple expansion. That means it doesn't have to earn $1 more in earnings and the price of the shares go up simply because the multiple of earnings grows, so too does the stock price. You get an added bonus here because they actually grew their earnings. So now you've got earnings growth, plus you've got a market multiple expansion on top of that, and you get a hockey stick, kind of ballistic looking chart. That's how you go. That's how you get 600% in a couple years. All right, let's do the cash flow one page. Here it is. We've got 10 years of history. We're going to dive into revenue, EBITDA, free cash flow, debt level, the whole thing. First, let's take a sip of the old wee beastie and see how it's going. That is definitely hot. That needs some water. Not a fan. Way too hot. Way too hot. Yes, this is a mason jar. So be it. You know what? It's too hot. It's so hot you can't even taste the standard Ardbeg. Give me 1 second. This is what you should be drinking. This is an Ardbeg that I picked up at the island of Islay in Scotland. I haven't opened it yet. This sucker, Anora, that is true Ardbeg. I know that this one has the same label on it, but at 5 years, nothing compared to this. This I'm saving for another day. But I digress. Let's get back to the cash flow one-pager. That's what you're here to watch. Let's dive into it. All right. What do we have here? How do we read this? So what you're trying to do, again, a stock is going to move around all the time. The market's going to serve up prices to you, and you need to be prepared for the market volatility because I showed you that price can fluctuate wildly. Look at this price drop. It was $375 roughly a share, and it collapsed down to $100. That's a 2/3, if not more, maybe what's that? 80% collapse from almost $400 to $100. Absolutely incredible, and the kind of panic that happens in the market has to be widespread. All the pundits have to be saying that it's going to go down because it's the only way to get the selling pressure to create the downward pressure to turn that price so negative. So what do? Well, you pull out your handy dandy one pager and you say, look, I thought this stock was a buy, when it was $300-400 and I was jealous that I didn't own it, but now you can buy it at $100 and you're scared not to buy it. That's what this is for. Let's dive right in here and figure out what we got. So in 2015, I'll do revenue. 2015, Meta had $18 billion of revenue. I'm going to read these numbers out to you so you get a feel for the rapid growth. 18 billion, 28 billion, 41 billion, 56 billion, 71 billion, 86 billion, 118 billion, 117 billion. That was the drop. It dropped in revenue from 118 billion to 117 billion, a $1 billion drop, a 1% drop, and the market absolutely freaked out. Then it reverted to an all-time high very next year, 135 billion, and then this year in 2024, full year it printed $165 billion of top-line revenue. That number is 28% annual CAGR that this sucker has grown. I could not believe that a multi-billion dollar company, $100 billion company, now over $1 trillion, could grow at 20% a year, but it does. It's just astronomical how much that has grown. And this stock could have been purchased for 7 times EBITDA. It's crazy. Anyways, EBITDA, earnings before interest, tax, depreciation, and amortization. Remember, the 5 key attributes that we look for: growing revenue, growing EBITDA, strong free cash flow, low debt, and well-priced. Well-priced is somewhat subjective. I'll give you that. But if you're patient, the world will serve something up for you. You don't have to be right very often. You get a couple of these in your portfolio and just go to the bank. You're fine. Like, the need for people to trade all the time, to talk about what they own, it's just insecurity. Sit back, wait for the stocks you love to come to you, and then go get them. EBITDA, 2015, 8 billion, 14 billion, 23 billion, 29 billion, 34 billion, 40 billion, 54 billion, 42 billion. That's the drop right there from 54 to 42. It's a decent sized drop. What's an $8 billion fall? Okay, I get it. A 12% drop. Not good. Next year, reverts all-time high, $60 billion. Then $85 billion last year in 2024. Absolutely amazing. The growth rate on that, 30% annual CAGR. I'm going to jump to adjusted free cash flow here just to make a point. Adjusted free cash flow of operations, 7, 13, 20, 25, 31, 32, 48, 38, that's the drop of 10, back up to all-time high, 57, 74. Growth rate, 29% annual CAGR. What do you notice about that I just rattled off for you? How similar is that to the EBITDA? Annual growth rate CAGR for free cash flow adjusted, 28%. Annual CAGR for EBITDA, 30%. That means the cash flow from operations on the cash flow statement and the EBITDA, or you can use operating income on the income statement, are moving in the same direction and growing very similarly. That is a very good sign that the accounting team is doing the job, doing what they're supposed to be doing. They're recording cash costs correctly in the P&L, at least with this smell test, and we love to see that. Love to see that. Debt levels was zero in 2015, grew to $50 billion. Excess cash is now at $34 billion, but total cash is about $77 billion. We're reserving some cash on the balance sheet, just to be cautious. Market cap is 300 billion. 300 billion. 300 billion. I'm going to read these off for you because it's important. 300 billion, 345, 524, 400, little dip, 580, 800, $945 billion, just shy of $1 trillion, collapse, 300 billion. It lost $700 billion in market cap. Let me say that again. It lost $700 billion in market cap. It went from a 17 times multiple to a 6 times multiple in 1 year. If that's not a kick in the teeth, I don't know what is. But what it prepared the market, what it presented to the astute, cash flow hungry buyer was an incredible opportunity to step into a monster stock that had been growing double digits for a long time and had a stumbling point. I get you. But you know what? With its market dominance, strong leadership, phenomenal financial position, it reverted and went back up from $300 billion. Now, fast forward 2 years, $1.6 trillion of market cap. Absolutely astonishing, ladies and gentlemen. That there is worth a nice sip of, honestly, scotch that's way too hot. But it's all I got. It's all I've opened. It needs time to sit. And that swig was a little too heavy. Here we go. Let's keep going. Enterprise value to EBITDA. It's one of the relative value metrics that we look at here in the channel. It's from my investment banking days. No, it's not free cash flow. And EBITDA is never meant to be a proxy for free cash flow. And everybody in the finance world knows that. That's why we look at free cash flow. But it's used as a very rough guess to compare relative value across companies within the same industry. That's why it's used. It's a quick smell check of the business cash flow. It's not supposed to be cash flow. But let's take a look. Growth multiples, 35 times in 2015, 20, 21, 12, nice drop, 16, 19, 17. So it's coming down. It's coming down because the growth rate's slowing down. And as growth rates slow down on growth stocks, the market multiple falls, comes down, weighs on the stock, and it pulls down the stock. But then it absolutely collapsed when they stumbled. It went from 7 times to 6 times. That there is an absolute disaster of a collapse. And then it reverted back to 15, and now it's at 19 times. Phenomenal. Debt to EBITDA is 0. Going to gloss forward to that. I talked about free cash flow. Let's take a look at CapEx. CapEx has grown considerably. Wow. $2.5 billion to 5 to 7, 14, 15 for a couple years, 19, 31, 27, now $37 billion. But look, they made in cash $74 billion. So let's get this. Well, I'll finish this example. So the debt is basically 0. They borrowed some money here in 17. In 2022, they borrowed 9. In 2023, they borrowed 7. And in 2024, they borrowed 8. That's wise, in my opinion. They're somewhat financing their CapEx. They're not paying all cash for it. They're just kind of somewhat subsidizing that with some debt, which is totally reasonable. Their leverage ratio is less than 1. It's it's 0.2 times EBITDA. So that debt is almost nothing for them. It's fine. But point here is, what do they make? At the end of the year, this is what happens. They run their business for the full 12 months. They generate in $164 billion of cash comes in. They pay marketing, they pay employees, they pay rent, they buy back stock, they pay lawyers, they do everything they're going to do. And the profit that they have before interest, tax, depreciation, amortization, which the last two are not cash. So before interest and tax, they have $85 billion sitting in the bank account. Okay, that's profit, not cash. You move over into the cash flow statement and you see cash flow from operations. That $85 billion shrinks a little bit because there's probably a difference between book tax and actual tax. There's some non-cash things that hit the balance sheet, so that's cash timing. So your $85 billion shrinks by $10 billion to $74 billion. But that $74 billion is real money. That's why we focus on the cash flow statement. Because the auditors, when they audit financials, they will call up the bank that Meta uses. I'm going to guess JP Morgan because I like the bank. I also like Wells Fargo, but the different story of why. They'll call up JP Morgan and say, hey, Mr. Morgan, what did Meta have January 1st of this year in the bank account? They had, $82 billion, making a number. Okay, what do they have at the end of the year? $85 billion. Okay, so they get a third party to verify a hard dollar amount that they had on premise. So it's much easier to tie physical cash than it is a profit, which can be adjusted by revenue recognition policy, CapEx depreciation policy, how they pay their employees. Is it cash or is it in stock? Do they have warrants? Is stock convertible? Are bonds convertible into stock? There's lots of ways you can kind of gear the P&L, but you can't make up, is the cash in the bank? That's why we like the cash flow statement. And back to my point. So the cash, the $85 billion of profit turns into $75 billion of pure hard cash. Like Scrooge McDuck kind of cash they can wallow around in if they wanted. Zuckerberg could out there and wallow around on it, which is kind of a funny thought. But then what do? Okay, they peel off $37 billion and go build a tech center. Well, they're still left with $40 billion or so. They borrowed a little bit of cash. They got an extra 8 in, so they're at $48 billion, $45 billion of free cash flow. That's how I get this number right here, $45.8 billion. That, my friends, is the free cash flow to equity. And I want to point out something very interesting. When the stock collapsed in 2022, and I called it a trifecta buy, that year it still printed a positive $16 billion of free cash flow and had a cash flow yield of 5%. So that stock, when you bought it in 2022 at the low, you're buying a company that had a long record of growing revenue, growing EBITDA, strong free cash flow. It had zero debt at the time, literally zero debt to EBITDA, and it was producing $16 billion of free cash flow to equity. That means at a 5% yield, you as the stock owner have an asset with no debt on it, a legacy of growing that's producing a 5% free cash flow at a time with the bonds in the Treasury Department were paying less than 1%. It was negative. So you're buying a stock with a bond-like collateral position because there's no debt in front of you. You as the equity holder have first claim on the assets should they go bankrupt. In the meantime, you're collecting, fictitiously, it's not actually collecting, but it's a 5% yield on your money, which is phenomenal for a growth stock. And then if it were to turn around, the upside here is tremendous. The downside is you have claim on physical assets and you have to work out, but you're collecting 5%. My point here is that in 22, the downside is much more limited than the upside was tremendous. And that's how you can spot a stock that is fall from grace and it might be time to buy it. So that's kind of the review of the historicals. If I take a look now at a forecast, we're following their trend. They're saying, hey, we're going to grow at double digits. We're going to give it a 33% growth in 2025 to EBITDA. That's $113 billion. It's going to grow to over $200 billion, just kind of growth rate coming down to about 5% annually. $200 billion long-term target for EBITDA. Apply 17 times multiple to this. That's a little higher than we have in the past. I think I've been a little too conservative with some of these mega stocks, some of the networking stocks. They seem to be able to last at a higher multiple for a long time. So we're taking that up a couple turns. But that says, hey, you should be a $3.6 trillion company out 10 years from now, or roughly $1,300 per share, an astronomical price. Cash flow is going to go from 13 a share to 33 a share at 2.5% yield. That's a $3,400 stock price. You can buy it right now today at $700. It's going to grow potentially to $1,300 to $1,400 out in the future. Plus, you get a pro rata share of this free cash flow. That's going to give you a 10 to 11% IRR for your 10-year hold period. And you'll notice that's down from when I called it a buy. Actually, in both reviews, I had a 17% IRR. I guess the latter review in November, when the stock bottomed at 100 times, I too had lowered my forecast. I was caught up in the whole market meltdown as well. But even at the lower forecast price, it still had a very high IRR with very little downside and risk, and it turned out to be true. So the moral of the story here is the lesson that the market is generally asleep. More than half the money in the market is indexed. This is an example. When people sell their SPY index fund in their 401k because the market's going down, they want to go to cash, they are inadvertently throwing away a gem of a company like this, and you get a stock that was trading at near $1 trillion enterprise value falls to 300 million enterprise value because everyone hits the sell button at the same time, regardless of value, regardless of cash flow, of anything. And so when you sit back and you have your cash flow one-pager, something like that, you're able to kind of sit back and say, hey, this is a very interesting stock. I like this stock for a long, long time. And here I am being served up a beautiful gem of a company at a phenomenal price. So sit back, relax, take a whiskey, think about your life and how you're long going to hold stocks for, and wait for prices to come to you. I'm going to quote Buffett here, and forgive me, everybody does. But I think the analogy is fantastic. It's a baseball one. I think he was talking about Lou Gehrig and how Lou Gehrig knew his strike zone. This normal strike zone is out that big. Well, Lou Gehrig said, I'm not going to swing at any of these balls because really my batting average is uber high if I only swing right here in this zone. So he just waited for the ball to be in that zone, would swing, and he'd have a higher batting average. Same thing here. You don't have to swing at every stock. You just have to hit the ones you go after. And if you have a collection of one-pagers, if you're a subscriber, just plug it in. No, don't hurt me. But if you're a subscriber and you have a stack of these sitting on your desk or on your side, and you're like, these are the companies, my wish list. These are the companies I would love to buy if they came into reasonable value. And when the market panics and sells, and you get something that absolutely craters, and everybody's telling you to get out of the market, you pull out the piece of paper and you say, wait a second. This stock has grown for a decade at 20% a year, has no debt. Like, if I'm going to roll the dice, if I'm going to be in equities, I'm a risk taker. Now's the time to take the risk. And that's how you make a lot of money in the stock market. That's how you beat the stock market. It's not by dollar cost averaging into a stock or two. You make 1 or 2 investments a year, and then you store your cash, and you wait till you have a swell of cash, and you go buy another one. Don't sell the stuff you have. Let it ride. It was a bet. It might take years to pan out. Let it go. Save more cash. Wait for the next one, and go after it. All right, this is meta review. Let's give it a review. So let's check the boxes here. So is revenue growing? Yes, revenue has been growing at 28% annually for the last decade. Is EBITDA growing? Yeah, it's growing. They're expecting it to grow. Free cash flow, you bet your butt it's growing. And it's very, very strong. They can afford their CapEx very, very easily. Low debt, debt's zero. Is it well priced? Yes, it's still well priced. It's priced to beat a market return. So I don't think you're going to crush it with this stock. But technically, if our objective is to beat the stock market and that stock market return in target is 10% over the long term, this is slightly higher than that. I think you have a good shot at beating it over the long run. That's how we look at stocks here. It's a relative value approach. My background, as you know, if you've been watching the channel, I'm a CFO for private equity companies. I run companies for a living, and I do this channel because during the pandemic and even post-pandemic, there's a lot of meme stocks out there, a lot of people buying and chasing returns, and I wanted to give a different perspective. So I've tried to create a channel that I believe is very unique in the world of finance on YouTube, where we dive into the detail, we read 10Ks, I teach you how to pull out cash flow and really understand how a business operates and runs. I run a cash flow club. You can find on my webpage, cashflowinvestingpro.com, or down and below. I also teach courses if you want to know how to build financial models, as an example, for an investment banking career. I have a course on that. If you want to learn how to buy cheap value stocks, I have a course on that you can take as well. Let me know what else you'd like to see. Throw a comment down below. I'm getting back in the swing of things. It's 2025. Let's do some stock. Let's find some cool cash flow. Hope all is well, and Happy New Year. Bye-bye, everybody.